It's always about the rate of change. And again, what happened yesterday or what I said last month or last year, the market has no memory for that. The market is always going to move on its path forward. The market finds its path forward, finds its catalysts. These are also nonlinear and dynamic. So again, when you look at where I was, what I said and what I thought then, it has nothing really to do with what I think now. I mean, when I get in the game now, I have to deal with the game that you're in, not the game that you'd like to have or rather have. And I know that questions about levels mean, well, if you didn't, if you couldn't buy the S&P 500 or get long stocks lower, then why would you buy them higher? I mean, well, why not? I just laid it up. I mean, so at the end of the day, it's all about the rate of change. And again, using the risk range is a huge navigator for you. So again, I'd accept that if the risk range, again, if we have a risk range currently, in the S&P 500, it's a pretty narrow range. If we're saying that 2190 is the top end of the range and 2162 is the low end of the range, I have no reason to believe until I get, in particular because I have some bullish catalysts. Again, bullish catalysts are bad economic data points. PMI, ISM, consumer confidence. We got a whole bunch this week, a jobs report. So, if we're just doing this, I'm happy to trade it, okay? What happened back here, what do you think I do? Wake up in the morning and go back to oh my God, I can't believe today is August. I can't believe that in July, on the 29th of July, I screwed up. Maybe I should think about that before I go on the ice today. I mean, have you ever played a sport? Have you ever done anything where you have to shake it off? You have to get with it. You have to clear your mind and get into the game. What happened back here, yeah, it's instructive. We have to learn lessons from that. But what's happening in here prospectively is what we're talking about, and that's what we should be focused on. Yesterday's game is over. Today's game is on.
Yeah, I mean, and the other thing too is you look at where the market is now relative to then, the market could have easily crashed then.
Yeah.
And it would have just taken maybe a few more people selling, and then it would have become reflexive. And
what made the stock market crash? Forget this is super short term. What made the stock market crash? If you go back from July of, if this chart starts right here and it says July 2015. Can you guys see that far down? Is that too low?
Yeah, it looks like it's.
Is that too far?
It's good.
Let's just say that I'm not making it up. Okay, so if you go back to 2134, July of 2015. Okay, the stock market by February of 16 was down 15%, okay? Minus 15%. We didn't miss that. What happened then was instructive for what's going to happen further. What was the catalyst for this really big point of entropy right here? I'll give you a hint. It happened right here in December, and it's called a Fed rate hike. So if the Fed were to raise rates, that's when, if that jobs number is good, I'd actually agree with the market. And if you break, actually, the trend line for the S&P 500 is actually 2169 right now. If we bounce, if the market bounces and then breaks down through 2169, and this starts to open up on the downside, wow, we got a lot to think about. And I'll be thinking on the fly. But in the meantime, I mean, I'm not looking for a bullish jobs report. I'm not saying that it's 100% guaranteed that the jobs report is going to be bad. I'm just saying if I had to pick bad or good, I'm going to be positioned for bad. Because again, I'm positioned for the trend, not for, if there wasn't an anomaly, it was actually last month's job report with a 255 or whatever the number was. I mean, I highly doubt that you get a back-to-back one like that, but that's just me. I mean, that's just an opinion, and that's only going to take you as far as our setup does for this week. That's very short term. It's a lot easier, obviously, getting these bigger moves right in bond yields if you stay with the quarterly views, which is, of course, what we do. It gets a little bit more difficult in here on the weekly.
Okay. I mean, so I guess if I could simplify that, the important point is from a quantitative perspective, is the S&P it's trend support right now is 2169.
Yeah. If the jobs report is bad, I think that this channel holds. If the jobs report is good, I think the market's going to look a lot like it did on Friday, where people are like, because guess what? The next jobs report could be bad. I mean, it's not like, can you imagine, I can imagine this because they did it in December. The Federal Reserve comes out, raises rates in September, and the September jobs report is 11,000 jobs. I mean, they're going to look so idiotic and moronic in short term if they do that. By the way, they've done it before.